Welcome back to the deep dive. This is where we take complex source material, synthesize the best insights, and turn them into knowledge you can use immediately. Today, we're opening up the playbook for one of the most, well, really important courses in public policy analysis. So, welcome to our fun little study group for PP 5375 Economic Analysis for Public Policy and Management.
That's right.
And specifically, these are the readings from Section 02, Fundamentals of Supply and Demand, and Section 03, Elasticity of Supply and Demand.
Exactly. And our mission here really is to get a solid grip on what economists call the workhorse of microeconomics. That's the supply and demand model. We're pulling together the core ideas from, well, quite a stack of materials here. We've got 02PUIND1.pdf, 02note1.pdf, 2 PowerPoints, ER2PPX1.pdf, and these are 2PTX2.pdf, and then for elasticity, O3note1.pdf and O3PPTX1.pdf.
Wow, okay, so a good chunk of reading.
It is, and the goal is to see how these fundamental forces, supply and demand, pretty much determine everything that happens in a market.
And when you say everything, you really mean it, don't you? Like predicting commodity prices, understanding what happens when the government steps in with price controls or taxes or subsidies.
Absolutely. It gives you incredible foresight if you understand these fundamentals. You can evaluate policy, predict market reactions. It's powerful stuff.
Okay, so we're starting with the basics, the foundation.
We are. But we'll move pretty quickly into the quantitative side using elasticity. That's how analysts go from just guessing the direction of change to making, actual precise forecasts.
All right, let's unpack this. Starting with the consumer side, demand. We often visualize this as the demand curve.
Right.
And basically, this curve just shows the quantity of something consumers are willing or able to buy as its price changes, assuming, of course, nothing else is changing.
And that leads directly to the law of demand. It's fundamental. Price goes up, quantity demanded goes down.
Simple enough.
It's that inverse relationship.
Okay.
That's why the demand curve always slopes downwards.
But let's pause on why. Why does it slope down? It's not just one thing, is it? The sources highlight a couple of key economic forces at play here.
Exactly. Two big ones. First, there's the substitution effect.
Okay.
So if the price of, say, copper goes up, what do people do? They look for alternatives that are now relatively cheaper, maybe aluminum, maybe fiber optics. They substitute away from the more expensive copper.
Makes sense. And the second one?
That's the income effect. This one's a bit more subtle, maybe. When the price of anything you buy increases, your actual spending power, your real income, it kind of shrinks, doesn't it?
Yeah, even if your paycheck is the same.
Right. Your dollar just doesn't go as far. So this reduced purchasing power generally makes you buy less of, well, almost everything, including the good whose price went up.
So those two effects together really drive that downward slope.
They do. And it's critical to remember what the curve represents at each site. It's the marginal willingness to pay.
Marginal willingness to pay.
Meaning, what's the maximum benefit or price that the last consumer to buy the product is willing to give up for that one additional unit? The curve maps that out.
Got it. And this precision is super important for policy analysis. We have to be really careful distinguishing between moving along the curve versus the whole curve shifting. They're totally different phenomena.
Absolutely critical distinction. A movement along the curve happens only because the price of that specific good changed.
Like if coffee goes from $3 to $4.
Exactly. You just move up along the existing demand curve.
Yeah.
That's a change in quantity demanded. You're just tracing the relationship that's already there.
But a shift, that's a whole different ballgame. That's a change in demand itself with a capital D.
Right. The entire curve moves left or right. And this happens because some other factor, something besides the price of the good itself, has changed consumers' desire or ability to buy it at any given price.
And tracking these shifters is basically what economic analysis is all about, right?
Yeah.
Predicting how these external factors change the market.
Pretty much, yeah. So let's nail down the big ones. Number one, income.
Okay.
For most things, economists call them normal goods. When people's incomes go up, they want to buy more of that stuff. So demand shifts, right? More income. More demand for cars, houses, whatever.
Makes sense. What else?
Number two, tastes and preferences. This is huge. Think about health trends, fashion fads, even, a big medical report.
Like the example in the notes, if the Surgeon General suddenly says red wine is amazing for your health.
Bingo. The demand curve for red wine just jumps to the right. People's fundamental preference change, regardless of the price.
Okay. Third.
Prices of related goods. This is really key for policy. We split this into substitutes and complements.
Substitutes, like Coke and Pepsi. or tea and coffee.
Exactly. Goods you could use instead of each other. If the price of coffee skyrockets, what happens to tea demand?
People buy more tea. Demand for tea shifts, right?
Precisely.
Yeah.
Then you have complements. These are goods used together.
Like cars and gasoline. Or printers and ink cartridges.
Perfect examples. If the price of gasoline shoots way up, people might drive less. So the demand for things related to driving, like motor oil or even new cars, could shift left. They're linked.
Got it. And the last big shifter.
This one's directly relevant for policy intervention. Taxes and subsidies that hit consumers directly.
Ah, like a housing voucher.
Exactly. A housing voucher effectively gives a consumer more purchasing power specifically for housing. It increases their willingness to pay, shifting the demand curve for housing to the right. It stimulates that specific market.
Okay, so that covers the demand side pretty well. Let's flip it. The producers. The supply curve.
Right. The supply curve shows the quantity producers are willing and able to sell at a given price. And importantly, we assume their production costs are held constant when drawing this curve.
And it usually slopes upward.
Typically, yes. Why? Because of the profit effect.
Mm.
A higher market price generally means it's more profitable to produce and sell that good.
So existing companies might ramp up production.
Yep. They might pay overtime, run extra shifts, and in the longer run, that higher price can even attract totally new companies into the market because it looks profitable.
So the supply curve kind of represents the marginal cost of production, the cost to produce that last unit.
Eventually, yes. As you try to produce more and more, costs often rise, so you need a higher price to justify it.
Okay. And just like demand, we need to distinguish movement along the curve from shifts.
Absolutely. A change in the goods own price causes a movement along the supply curve. That's just a change in quantity supplied.
But the interesting stuff for analysis is when the whole curve shifts because something other than the price changed.
Exactly. A change in supply, capital S.
So what are the main supply shifters? What moves the whole curve?
Number one, and probably the biggest, input prices or production costs.
Wages, raw materials, energy, stuff like that.
Precisely. If the cost of any key input goes down, maybe wages fall, or the price of steel drops, producing becomes cheaper, more profitable at any given selling price. So the supply curve shifts right, or outwards. Producers are willing to offer more at every price.
Okay. What else shifts supply?
Technology. And technology here doesn't just mean fancy new gadgets. It means any improvement in production methods that saves labor, time, or resources.
Like automation in factories or better farming techniques.
Perfect. Computers controlling assembly lines, mechanized harvesting. These things drastically cut production costs per unit. Shifting the supply curve to the right, you can produce more efficiently.
Makes sense. And the third big one, similar to demand.
Yep, taxes and subsidies, but this time levied on producers.
Ah, okay. So like a tax per unit produced.
Exactly. A per-unit tax, like maybe a carbon tax on emissions from factories, acts just like an increase in production cost. It makes selling less profitable at any given price, shifting the supply curve to the left or inwards.
And subsidies do the opposite.
Right. A subsidy to producers, like, say, the low-income housing tax credit, which helps developers build affordable housing, or maybe a subsidy for installing solar panels.
Yeah.
That effectively lowers their costs.
So it shifts supply right.
Shifts supply right.
Got it.
The government is essentially paying part of the production cost, making it more attractive to supply that good or service.
Okay, so we've got these two forces, demand sloping down, supply sloping up. What happens when they meet in the marketplace?
This is where the magic happens, so to speak. This is the market mechanism. It's the natural tendency in a competitive market for the price to adjust until the amount producers want to sell is exactly equal to the amount consumers want to buy.
And that meeting point is?
That's equilibrium. It gives us the market clearing price, we often call it P0 or P star, and the equilibrium quantity, Q0 or Q star.
Market clearing, meaning everything produced gets sold.
Exactly. At that specific price, P dollars, the quantity supplied equals the quantity demanded. The market is balanced. There's no inherent pressure for the price to change anymore. Everyone willing to pay P dollars finds a seller, and every seller willing to accept P dollars finds a buyer.
But markets aren't always perfectly balanced, right? What if a seller tries to charge more than the equilibrium price, say P dollars?
Good question. If the price P$1 is above P dollars, look at the curves. At that high price, producers are eager to sell a lot. Q dollars is large, but consumers aren't so keen. Q dollars is small.
Yeah.
You end up with Q dollars being greater than Q dollars.
So, unsold goods piling up.
Precisely. That's a surplus, or excess supply. What do producers do when they have warehouses full of unsold stuff?
They cut the price to get rid of it.
Exactly. They lower the price. And as the price falls back down towards P dollars, two things happen. Producers offer a bit less, movement down the supply curve, and consumers demand a bit more, movement down the demand curve. That continues until the surplus disappears at P dollars.
Okay, and the flip side. What if the price is somehow set below equilibrium, maybe P2 $2, like a sale price that's too low?
Right. At a low price, P2 consumers are thrilled. They want to buy a lot. Q2 is large. But producers, at that low price, it's not very profitable, so they don't offer much. Q is small. Now, Q is greater than Q25.
Empty shelves. People wanting stuff they can't find.
That's a shortage or excess demand. And what happens when lots of people want something scarce?
They start offering more money for it, bidding wars maybe, or just long lines.
Exactly. Consumers effectively bid the price up. As the price rises back towards PDD $2, producers are incentivized to supply more, and consumers start to demand a bit less. The shortage shrinks until it vanishes at the equilibrium P dollars. The market finds its balance.
It's like an invisible hand guiding it back. But we should probably mention the big assumption here, right?
Absolutely crucial. This whole beautiful mechanism relies on the market being reasonably competitive, meaning there are enough buyers and sellers so that no single one has significant power to just dictate the price. Everyone is basically a price taker. If you try to charge way more than the market price, buyers just go elsewhere. If you try to offer way less, sellers ignore you.
So this model doesn't really work for, say, a monopoly where there's only one seller?
It gets much more complicated there, yes. The basic S&D model assumes competition.
Okay, assuming we have a competitive market, this framework lets us do some powerful qualitative analysis, right? Like predicting what happens when things shift.
Definitely. Let's say a new technology makes production cheaper. That shifts supply right. What happens to equilibrium?
More stuff available, cheaper cost, price should fall, and the quantity sold should increase?
Exactly. The equilibrium point moves down and to the right. New equilibrium price, P3D3 is lower. New quantity, Q330 is higher.
And if, say, incomes rise and people want more of the good, demand shifts right.
Okay, think about it. More people wanting the good. They'll bid the price up. And producers will respond to the higher price by making more.
So price rises, quantity rises.
Correct. Equilibrium moves up and to the right.
But what about those tricky situations where both curves move?
Yes. That's where simple qualitative analysis starts to get fuzzy, especially regarding the price. Suppose both supply and demand shift right. Maybe costs fall and income rises.
Well, if supply shifts right, quantity goes up. If demand shifts right, quantity goes up. So quantity definitely increases, probably by a lot.
For sure. $T will definitely increase. But what about the price? $2.
Supply shifting right pushes price down. Demand shifting right pushes price up. So it depends.
Exactly. The final effect on price is ambiguous. It depends entirely on the relative size of the shifts. If the supply shift is huge and the demand shift is small, the price will likely fall. If demand shifts way more than supply, the price will likely rise.
So just knowing the direction of the shifts isn't always enough to predict the price outcome.
Correct. For that, you need to know the magnitude of the shifts or have some idea about the shapes of the curves. And that leads us toward needing quantitative tools, like elasticity.
Okay, let's make this concrete. The source materials have some fantastic real-world examples showing how these S&D shifts explain big market changes that might seem weird otherwise.
They really do. The comparison between eggs and college education from 1970 to 2010 is a classic.
Right. The real price of eggs absolutely plummeted, down like 55%, while college tuition, well, we all know that story, it exploded, up over 80% in real terms. Why the huge difference?
Let's break it down. For eggs, supply shifted massively to the right. Why? Mechanization, automation, and poultry farming. Costs just fell through the floor.
Okay, supply right pushes price down. What about demand?
Demand actually shifted a bit left. Think about the cholesterol scares back then. Health consciousness made people a bit warier of eggs.
So demand left pushes price down too. Wait, if both push price down?
The supply shift right was so enormous compared to the small demand shift left that the net effect was a huge price drop. Interestingly, even with the demand shift left, overall consumption still rose slightly because the price drop was so dramatic.
Fascinating. Now, contrast that with college education. Supply.
Supply arguably shifted left or upwards, representing higher costs. Think rising costs for faculty, labs, administration, regulations. It just became more expensive to provide a college education unit.
Okay, supply left pushes price up. And demand.
Demand shifted massively to the right. Getting a college degree became seen as much more essential for getting a good job, for social mobility. It went from almost a luxury to a perceived necessity for many.
So demand right pushes price up, both forces pushing price up.
Exactly. When both supply shifts left and demand shifts right, you get a double whammy, pushing prices higher. And in this case, the demand shift was so strong it also pulled enrollment quantity way up, despite the rising costs.
That really clarifies those trends. What about the natural resource prices example, like copper? Demand went up like crazy over 100 years, right?
100-fold increase in consumption, a massive sustained demand shift, right, due to industrialization, population growth, everything. You'd instinctively think the price must have skyrocketed as we used it all up.
But it didn't. The real price stayed pretty flat. Why? Technology, again, on the supply side. While demand was booming, the supply curve was also shifting right, and arguably even faster than demand.
Oh.
Discoveries of vast new copper deposits helped, but the real driver was huge technological improvements in mining, smelting, refining. It just became dramatically cheaper in real terms to get copper out of the ground and ready for use. The cost reductions kept pace with or even outpaced the demand growth.
Amazing. Okay, now for that really counterintuitive one. NYC office space after 9/11, the Twin Towers fell, taking out a huge chunk of office space. Supply clearly shifted left.
Right. About 10% of downtown Manhattan's inventory vanished overnight. Basic S&D says, less supply, price should shoot up, right?
That's what you'd think.
Really?
But the sources say the average rental price actually fell and vacancies went up. How is that possible?
Because the initial analyses missed the simultaneous and massive demand shift.
Oh, what happened to demand? It also shifted sharply left. Firms drastically reevaluated risk, worried about quality of life, maybe moved operations out of the city center or delayed expansion plans. Plus, there was a broader economic slowdown happening. Businesses just didn't want as much downtown office space anymore, at any price.
So the drop in demand was bigger than the drop in supply?
Apparently so. The leftward shift in demand was so significant that it overwhelmed the leftward shift in supply. The net result was a lower equilibrium price and higher vacancy, lower quantity demanded. It's a stark reminder to always consider both sides of the market, especially after a major shock.
Wow. And this S&D framework even helps explain social trends like wage inequality in the U.S. since the 80s.
Absolutely. You can think of the labor market as having different segments, like skilled and unskilled labor, each with its own supply and demand.
Okay. So for unskilled workers,
Supply generally grew quite a bit, shifted, right, due to factors like immigration and demographic changes. But the demand for unskilled labor, it didn't grow nearly as fast, partly due to automation replacing some roles.
so supply shifts right more than demand shifts right.
Yeah.
That pushes wages down.
Exactly. The result was stagnant or falling real wages for many unskilled workers over that period.
Now, contrast with skilled workers, engineers, managers, people with tech skills.
Their supply also grew, but much more slowly. It takes time and education to create skilled workers. But their demand, it exploded.
Why?
Think about the rise of the high-tech economy, computerization, globalization. All these trends dramatically increased the need for highly skilled, educated workers. Demand shifted massively to the right.
So huge demand shift right, smaller supply shift right,
Right.
wages go way up.
Precisely. The strong demand pull combined with relatively slower supply growth led to a significant increase in real wages for skilled workers. Supply and demand dynamics are fundamental to understanding that widening wage gap.
Okay, this S&D framework is great for understanding the direction of changes. Price up, quantity down, etc. But policy often needs numbers. How much will things change?
Exactly. If we put a tax on soda, will consumption fall by 1% or 30%? That's a critical difference for public health policy and tax revenue. This is where elasticity comes in.
Right. Elasticity. What is it, fundamentally?
It's a measure of sensitivity or responsiveness. Formally, it's the percentage change in one variable like quantity demanded that results from a 1% increase in another variable like price.
And it's a ratio of percentages.
Yes, which is key, because it's unitless percent divided by percent cancels out units. That means we can compare the elasticity of demand for, say, wheat, measured in bushels, with the elasticity demand for cars, measured in vehicles. Gives us a common yardstick.
Okay. So the main one is price elasticity of demand, EPTI. That's percent change in quantity demanded divided by percent change in price.
Correct. EPP always are delta QD. Usually are.
And because price and quantity demanded move opposite ways, law of demand, this number is usually negative.
Almost always negative, yes.
Yeah.
But often, especially in discussion, we talk about its magnitude or absolute value. How big is the response, ignoring the minus sign?
And that magnitude tells us if demand is elastic or inelastic.
Exactly. If the absolute value of e-powers is greater than 1, we say demand is elastic.
Meaning,
Quantity demanded is very responsive to price changes. A 1% price increase causes more than a 1% drop in quantity demanded. Think of goods with lots of close substitutes. If one brand of coffee raises its price, people easily switch.
okay. And if the magnitude is less than 1,
Then demand is inelastic. Quantity demanded is relatively unresponsive to price changes. A 1% price increase causes less than a 1% drop in quantity demanded.
like necessities, things you can't easily substitute away from.
Precisely. Think gasoline in the short run, or maybe life-saving medication. Even if the price goes up, people still need to buy almost the same amount because there aren't good alternatives.
Are there extreme cases?
Yep. Perfectly. Inelastic demand means the elasticity is zero. The demand curve is vertical. Quantity demanded doesn't change at all, no matter the price. Think theoretically of an insulin-dependent diabetic's demand for insulin.
And the other extreme.
Infinitely elastic demand. Elasticity is infinite, the demand curve is horizontal. This implies that even the tiniest price increase above the current level would cause demand to drop to zero. This occurs in theoretical models of perfect competition, where consumers see all firms' products as identical.
Okay, one tricky point from the notes. Elasticity isn't always constant along a demand curve, right? Even if it's a straight line.
That's a really important, often counterintuitive point. For a typical linear straight-line demand curve, elasticity changes as you move along it.
How so?
Remember, elasticity is about percentage changes. At the top left of the demand curve, high price, low quantity, a small price drop is a small percentage change in price. But the resulting quantity increase might be a large percentage change from the small starting quantity. So demand is elastic up there.
And at the bottom right, low price, high quantity.
The reverse. A price drop is now a large percentage change from the low starting price, but the quantity increase is a smaller percentage change relative to the already large quantity.
Okay.
So demand is inelastic down there.
Huh. So where you are on the curve matters a lot.
It does. And this leads to a practical issue in calculating elasticity over a significant price change. If you calculate it using the starting price and quantity, you get one answer. If you use the ending price and quantity, you get a slightly different answer because the base values for the percentages changed.
That seems problematic.
It can be, which is why analysts often prefer the arc elasticity formula, or the midpoint method.
How does that help?
Instead of using the initial or final price and quantity as the base for calculating percentage changes, it uses the average, or midpoint, of the starting and ending prices and the average of the starting and ending quantities.
Ah, so it gives you a single, consistent elasticity measure over that whole price range, regardless of whether the price went up or down.
Exactly. It provides a more robust measure for analyzing larger price changes often seen in policy scenarios.
Okay, price elasticity of demand is central. But responsiveness isn't just about price, right? What other elasticities are important?
Definitely. Two other big ones are income elasticity and cross-price elasticity. Let's start with income elasticity.
That measures how quantity demanded changes when income changes.
Precisely. Income elastic delta QD, percent delta IST, or I is income. It tells us how sensitive demand for a good is to changes in consumers' incomes.
And we use this to classify goods.
We do. If ESO positive, it's a normal good. As income rises, people demand more of it. Most goods fall into this category.
But not all.
Not all. If ESO negative, it's an inferior good.
Inferior, meaning as people get richer, they buy less of it.
Exactly. Think maybe cheap instant noodles or long-distance bus travel. As someone's income increases, they might switch to fresh pasta or flying. Demand for the inferior good falls.
Interesting. And within normal goods, there's another distinction.
Yes, based on the magnitude of each I do. If it's positive but less than 1, ESO ETB11, we call it a necessity. Demand increases with income, but not proportionally. Think basic food, fuel, electricity. You buy a bit more as you get richer, but not drastically more.
Okay. And if ESO is greater than 1?
That's a luxury. Demand increases more than proportionally with income. Think sports cars, expensive vacations, high-end electronics. These are things people splurge on as their income rises significantly.
Got it. So that's income elasticity. What about the other one, cross-price?
Cross-price elasticity, EQBP. This measures how the quantity demanded of one good, say butter, good B, changes when the price of another good, say margarine, good P, changes. EQBPB is bottom 2 p.m.
And this tells us if goods are substitutes or complements.
Exactly. If the cross-price elasticity is positive, the goods are substitutes.
Like butter and margarine. If the price of margarine goes up.
People buy less margarine and switch to butter, so the quantity demanded of butter, QB, goes up. A positive price change leads to a positive quantity change, EQBP days.
Makes sense. And if it's negative?
Then the goods are complements, used together. Think gasoline and motor oil. If the price of gasoline goes up, people might drive less, so their demand for motor oil also goes down. A positive price change for one leads to a negative quantity change for the other. EQBP dollars.
Okay, that covers the demand side elasticities pretty well. What about supply? Price elasticity of supply.
Percent delta PS. Percent delta P does. How much does a quantity supplied respond to a change in the market price? It's usually positive because higher prices incentivize more supply.
And what determines how big E-dollars is?
Many factors, but perhaps the most critical one, which applies to both supply and demand elasticities, is time. The short run versus the long run.
Ah, this seems really important based on the notes. How does time affect elasticity?
Dramatically. Let's take demand first. Time allows people to adjust their behavior, their habits, even their capital stock, like cars or appliances.
Okay.
Gasoline, a non-durable good. In the short run, if gas prices spike tomorrow, what can you do? Not much. You still have to drive your current car to work. Demand is very inelastic. Maybe EP equals 9 is in 1, or 9 is 1 more, or 9 is in 2.
But in the long run?
Over months or years, you can buy a more fuel-efficient car, move closer to work, maybe public transit improves. There are many more ways to adjust. So long-run demand for gasoline is much more elastic. Maybe EP equals 9 is in 7.7 or 9 is 4.8.
So for non-durables, long-run demand is more elastic than short-run?
Generally, yes. But now consider durable goods, like cars themselves or major appliances.
How does that work?
Here, the relationship often flips. The short-run demand elasticity is often larger, more elastic than the long run.
Wait, why?
Think about cars. If car prices suddenly jump up, or if there's an economic downturn, what can you do immediately? You can postpone buying a new car. Just keep your old one running for another year or two. Demand drops sharply in the short run. So maybe short-run AP equals 9 is 1 to SE.
But eventually,
your old car will die and need replacing. You can only postpone for so long. So the long-run demand, reflecting the ongoing need for replacement, is actually less elastic. Maybe long-run EP equals negative $4 in feel. The initial shock wears off as replacement cycles kick in.
Huh. That's really interesting. And this affects income elasticity too, especially for durables.
Hugely.
Yeah.
Short-run income elasticity for durables is typically much larger than long-run income elasticity.
Why that pattern?
Because the total stock of durables people want changes relatively slowly with income. But to achieve even a small change in that desired stock, the change in current purchases can be massive. Think about businesses and capital equipment during a recession. GDP dips slightly. Firms might slash new equipment purchases dramatically in the short run, even if their long-run desired capital stock hasn't changed much.
So industries making these durable goods are really sensitive to economic ups and downs.
Extremely. They're called cyclical industries. Autos, manufacturing equipment, construction. Their sales tend to magnify changes in GDP because of this high, short-run income elasticity of demand for durables. A small recession can cause a huge slump in their orders.
Wow. Okay, what about supply and time?
For supply, the general rule is usually simpler. Long-run supply is more elastic than short-run supply.
Why?
Because it takes time for firms to expand capacity. In the short run, they might be constrained by their existing factory size or workforce. They can maybe run overtime, but that's it. To significantly increase output often requires building new plants, installing more machinery, training workers. That all takes time, so they can respond much more fully to a price change in the long run.
Makes sense. But there was that weird exception for recycling.
Yes, the copper example, again, looking at secondary supply. Scrap metal. For commodities like copper, where recycling is significant, the short-run secondary supply can actually be more elastic than the long run.
How does that work? Seems backwards.
Think about it. If the price of copper suddenly spikes, there's an immediate, powerful incentive to gather up all the easily available scrap, old plumbing, wiring, junked radiators, and melt it down. Get a quick surge in supply from this existing stock.
Okay.
But that stock of easily accessible scrap is limited. Once it's been drawn down, further increases in supply become harder. You need to find more dispersed or harder to process scrap. So while the initial response to a price hike is strong, elastic short-run supply, the ability to keep increasing supply from scrap diminishes over the longer term. less elastic long-run secondary supply. Primary supply, mining new ore, follows the usual pattern of being more elastic in the long run.
All right, we've got the mechanics and the sensitivity measures down. Now let's connect elasticity directly to the money. Total revenue, TR, which is simply price times quantity. TR equals P times QR.
This is where elasticity becomes incredibly practical for businesses and, importantly, for public policy decisions involving fees or taxes. The core question is, if we change the price, what happens to our total revenue?
And the answer depends entirely on elasticity.
Entirely. Let's say demand for your product or service is inelastic. Magnitude of EPI is less than 1. What happens if you raise the price?
Inelastic means quantity doesn't drop much. So the higher price should dominate, revenue goes up.
Exactly. If demand is inelastic, a price increase leads to a higher total revenue. The percentage increase in P is bigger than the percentage decrease in Q. This is key for things like public transit fares or utility charges, which often face inelastic demand.
Okay. And if demand is elastic, magnitude greater than 1.
Now, if you raise the price, the quantity demanded drops off proportionally more than the price increase. Consumers flee. So raising the price actually leads to lower total revenue.
Because the drop in Q overwhelms the rise in P.
Precisely. Think about trying to sharply increase the price of a specific brand of soda when there are dozens of alternatives. Sales would likely plummet, killing your revenue.
And if elasticity is exactly 1 unit elastic,
Then the percentage change in P is exactly offset by the percentage change in Q, and total revenue stays the same.
this has huge implications for taxes, right? Like those luxury taxes mentioned.
Absolutely. If a government puts a big tax on, say, luxury yachts, hoping to soak the rich and raise revenue, they need to check the elasticity. Demand for specific luxury goods is often highly elastic because wealthy buyers have many other ways to spend their money.
So the tax raises the price, demand plummets.
And the quantity sold falls so much that the government might end up collecting less tax revenue than they projected, or even less than before. Plus, the industry producing those yachts suffers job losses. It can backfire badly if you tax a highly elastic good.
The notes had that table showing elasticities for public services. That seemed really relevant.
Very relevant for public administrators. It showed things like education and police fire services tend to have relatively inelastic demand, with estimated price elasticities maybe around manage 0.15 to manage 0.5 or manage 0.7.
So what does that imply for, say, raising user fees for those services?
It suggests that moderate increases in fees might not drastically reduce the quantity demanded of those services. People generally still need schools and emergency services. Therefore, raising fees in these cases could be a viable way to increase total revenue for the municipality or agency.
Unlike trying to raise fees for something with elastic demand, like maybe public swimming pools or golf courses.
Exactly. If those have more substitutes, private pools, other recreational activities, demand might be more elastic, and raising fees could drive users away and lower revenue. You have to know your elasticity.
Okay, let's shift back to direct government intervention, price controls, setting maximum or minimum prices.
Right. The classic example is a price ceiling, where the government sets a maximum legal price below the free market equilibrium price.
Like rent control or caps on gasoline prices.
Exactly. What does our S&D model predict will happen?
Well, at that low price P max, consumers demand a lot. Q dollars is high, but producers are discouraged and supply less. Q ball is low, so
QD, QB, QSs.
this means a shortage. Not enough goods to go around at the controlled price.
Always. Price ceilings inevitably create shortages. The source material gives the natural gas shortages in the U.S. during the 1970s as a prime example. Price controls kept the price way below equilibrium.
And the result?
Massive excess demand. The analysis estimated 8.5 trillion cubic feet in 2007 based on market conditions then. This led to curtailments, factories shutting down because they couldn't get fuel, huge economic inefficiency caused directly by ignoring the market mechanism. Producers lose, lower price, less output. Some consumers win, get the good cheap if they can find it, but many other consumers lose, can't buy it at all.
And rent control works the same way, sets a maximum rent below market equilibrium.
Same fundamental logic. It leads to a housing shortage, excess demand, but it also has other nasty side effects. Landlords facing low controlled rents have less incentive to maintain the property or build new units. Quality deteriorates, and you often get black markets or key money demands as people try to get around the controls. The quantity and quality of housing supplied tends to fall over time.
Okay, we've seen the qualitative power and the policy pitfalls. But you mentioned analysts need to make quantitative predictions. How do they actually estimate those S&D curves?
Right. You can actually do back-of-the-envelope estimations if you have a few key pieces of information. This is about fitting linear curves to the data you have.
So we want to find the actual equations, like demand, $chiwi a DP and supply, $2 plus DPE. Finding those constants A, B, C, and D.
Exactly. And what do you need to figure those out? You need the current or the known equilibrium point,
Yeah.
the price, and quantity.
Okay, the P and Q where supply equals demand right now.
Yep. And you also need reliable estimates of the elasticities at that equilibrium point, the price elasticity of demand, and the price elasticity of supply.
Where do those elasticity estimates come from? Previous studies? Econometric analysis?
Usually, yes, from existing research or statistical analysis of historical market data. Once you have PIV, ED day, and E-dollars, you can work backwards. Well, remember the formula for point elasticity, say for demand. ED equals B times PQ. Since you know E die and Q, you can solve for the slope term, B.
Ah, okay. And similarly for supply, using E dies at T times PQ to find D.
Precisely. That gives you the slopes of your linear curves. Then you just plug your dollars back into the basic equations, QE, EBP, or and you Q equals C plus DP or, along with the slopes, B and D you just found, and you can solve for the intercepts, A and C.
So you end up with the specific numerical equations for supply and demand in that market?
You do. The example used in the sources is the long-run world copper market. They started with P $3 per pound, Q $89 million metric tons per year, ES $1.55, and EDL 555.
And plugging those into the formulas?
They calculated the slope for supply, 299, and the slope for demand, B free T lovers. Then solving for the intercepts gave C at 2 idle sons and T99.
So the resulting equations were demand Q equals 27 3P2 and supply 2Q equals 9 is 9 plus 9PT.
Correct. Now you have a working model of the copper market.
And the power of this is you can then simulate changes, like that scenario of a 20% decline in demand.
Exactly. Maybe copper is being replaced by aluminum or fiber optics. How does that 20% drop affect price?
You take the demand equation and just reduce the quantity demanded at every price by 20%.
Yep. The new demand equation becomes Q new equal 0.8 times 27.3p, which simplifies to Q new 21.6 $2.04p2. The supply equation, quantity of need to 9 plus 9p2, hasn't changed.
So then you find the new equilibrium by setting new demand equal to supply. $21.06, $2.04p equals 9 is 9 plus 9p2.
Right. Solve that equation for P.
And the answer comes out to.
The calculation yields a new equilibrium price of PP equals $2.68.
Well, the 20% drop in demand didn't cause a 20% drop in price. It caused a drop from $3 to $2.68, which is about 10.7%.
Precisely. That's the quantitative prediction you get from fitting the curves. It's much more specific than just saying price will fall.
That predictive power is really highlighted in the world oil market example, especially comparing short-run and long-run effects of a supply cut.
Absolutely. That example is crucial. Let's say the starting point is P, 80 double barrel, and Q, $32 billion barrels a year. The key is the huge difference in elasticities. Short run. Both ED and ALD are tiny, maybe around 0.05 in magnitude, very inelastic. Long run, they're much larger, maybe 0.30 more elastic.
Okay. Now imagine a major disruption. Saudi Arabia cuts supply by 3 billion barrels per year. What happens in the short run?
With those incredibly low short-run elasticities, neither consumers nor other producers can react much immediately. Taking 3-paper off the market forces the price way, way up to clear the market. The calculation shows the price more than doubles, spiking to over 103 pounds per barrel.
Wow. Extreme volatility. But what about the long run?
In the long run, consumers have adjusted, bought efficient cars, etc., and other oil producers have had time to ramp up output. Demand and supply are more elastic, around 0.30. Now, that same 3-beer cut has a much smaller impact on price.
How much smaller?
The calculation using the long-run elasticities shows the price only rises to about $95.81 cents per barrel. Still higher than the original $80, but vastly different from the short-run spike to $173.
So knowing whether you're analyzing a short-run shock or a long-run adjustment is absolutely critical for getting the prediction right.
It's vital. Using long-run elasticities to predict the immediate impact of a supply disruption would lead you to drastically underestimate the price volatility and the potential economic chaos. Policy responses need to be based on the relevant time horizon.
This really brings it all together, from the basic shapes of the curves to understanding why elasticity differs over time, and then using that to make specific forecasts. It really is the workhorse.
It truly is. We've seen how S&D diagrams give us the qualitative story explaining long-run price stability for copper, despite booming demand, or the counterintuitive fall in NYC office rents. And then elasticity gives us the quantitative teeth to predict how much things change and to understand why interventions like price controls often lead to such predictable negative consequences like shortages.
So let's leave our listeners with that final thought, tying back to those simultaneous shifts, like in the NYC example after 9/11, where both supply and demand fell. Imagine you're a policy analyst. You see an event where maybe it's a new environmental regulation, maybe it's a sudden change in consumer confidence that you know will reduce both supply and demand in a particular market. How could you quickly, even qualitatively, make an educated guess about whether the final market price is more likely to rise or fall? What would you need to know or estimate about the relative shapes or sensitivities of those supply and demand curves? Think about which curve might be steeper or more inelastic than the other and what that implies for the ultimate price outcome when both shift inward. It really gets you thinking about the underlying power dynamics within the market mechanism.